Looking for the best places to invest in property in 2026. This is a data-driven outlook, pulling from analysis by the IMF, World Bank, Reuters, and reports from major investment banks and real estate experts. Now, this isn't financial advice, but it is a macroeconomic framework to help you understand where and why opportunities might pop up in 2026. We re-zeroing in on property investment and the countries best positioned for the next phase of the cycle. First up, Spain. It's shaping up to be one of the strongest property markets for 2026. Why? The tourism recovery is in full swing. There's a continuous flow of digital nomads, and property prices are still cheaper than in France or Germany. Plus, as interest rates eventually fall, variable rate mortgages will benefit the fastest. The Financial Times has noted that Southern European banks and property markets historically get an early boost from rate easing. The best segments to look at in Spain are short-term rentals on the outskirts of Barcelona, residential properties in Valencia and Malaga, and mid-priced housing with strong rental demand. Spain really offers that rare combination of immediate cash flow and long-term growth. Next, let's talk about Portugal. It remains a stable and attractive destination for long-term property investors. Portugal offers political stability, high rental demand from a growing expatriate community, and a limited housing supply in its major cities. This isn't a market for quick speculation. It's a yield-focused market. The best segments here are residential properties in Lisbon and Porto, focusing on long-term rentals where consistent yields matter more than rapid price jumps. Portugal is a market that rewards patient capital. Now, let's head over to the United States, but with a selective approach. The U.S. property market in 2026 is all about selection, not broad-scale buying. So, why does the U.S. still matter? There's a persistent housing shortage. Prices saw a correction in 2024 and 2025, and better entry points are now emerging in specific regions. The Urban Land Institute reports that valuations have reset, and a recovery phase is expected to begin in 2026. The best states to watch are Texas, Florida, the Carolinas, and Arizona. What should you avoid? Over-leveraged commercial office properties and markets with heavy regulation and weak population growth. For those with a higher risk appetite, let's look at India. India offers one of the highest growth profiles among major economies. Why India? GDP growth is projected around 6% or higher. There's massive urbanization happening, and strong domestic consumption is driving the economy. This is a growth-driven market, not a defensive one. The best segments are residential properties in Tier 1 cities like Bangalore and Mumbai, as well as logistics and industrial parks that support the country's manufacturing and trade boom. India offers significant long-term upside, but be prepared for higher volatility. Of course, not every market is well positioned for 2026. A few countries warrant caution. China is still dealing with its property downturn, weak consumer confidence, and structural debt issues. According to Deloitte, the sector remains under pressure. In Germany, you're looking at weak economic growth, high regulation, and limited pricing power for landlords. And in Canada, there's a severe affordability crisis and high household debt, which limits the upside relative to the risk. These markets might recover in the long term, but 2026 presents elevated risk. So, to wrap it up, successful property investment in 2026 isn't about chasing hype. It's about understanding macro trends, interest rate cycles, and structural demand. The strongest opportunities appear to be in Southern Europe. Select US